Are you ready to unlock the potential of your 10K investment and discover which ETF could help you achieve financial freedom? In today's video, we're diving deep into a detailed comparison of two popular ETFs, SCHD and VGT. SCHD is known for its focus on high dividend-paying companies, ensuring a steady income stream for investors. On the other hand, VGT targets tech giants, promising significant growth potential. By the end of this video, you'll have a clear understanding of the strengths and weaknesses of each ETF and learn how they can help you reach a portfolio of over $2 million or generate $25,000 in annual dividends with less than $150 per month in investments. Stay tuned as we uncover the secrets behind these ETFs, providing you with the insights you need to make an informed investment decision. If you want more tips on building wealth, hit the subscribe button. Your support helps us create more valuable content for you. Introduction of ETFs. When it comes to choosing between SCHD and VGT, understanding the core focus and strategy of each ETF is crucial. SCHD, or the Schwab U.S. Dividend Equity ETF, is designed to invest in high dividend-paying companies. Its primary goal is to provide investors with a steady and reliable income stream through consistent dividend payouts. This ETF targets companies with a robust history of dividend payments, making it an attractive option for those who prioritize income stability and are looking for a dependable source of regular returns. On the other hand, VGT, or the Vanguard Information Technology ETF, takes a different approach by focusing on the technology sector. VGT invests in some of the largest and most influential tech giants, such as Apple, Microsoft, and NVIDIA. The primary objective of VGT is to capitalize on the rapid innovation and growth within the technology industry. This ETF aims to deliver significant capital appreciation over time, driven by the advancements and developments in the tech sector. For investors seeking high growth potential and willing to embrace the volatility that comes with the tech industry, VGT presents an exciting opportunity. By comparing these two ETFs, investors can align their investment choices with their financial goals, whether they seek the steady income provided by SCHD or the growth potential offered by VGT. Performance comparison. When evaluating SCHD and VGT, one of the most critical aspects to consider is their performance, both in terms of stock price appreciation and dividend payouts. Stock price performance. Over the past decade, SCHD has demonstrated solid performance with an average annual share price appreciation of around 7.9%. This consistent growth reflects the stability and reliability of the companies included in SCHD's portfolio. Investors in SCHD can expect steady, moderate growth, which aligns well with the fund's focus on high dividend-paying companies. While it may not boast explosive gains, SCHD offers a balanced approach with lower volatility, making it a suitable choice for conservative investors looking for dependable growth. For instance, if you had invested $10,000 in SCHD 10 years ago, your investment would have grown to approximately $21,000 today, based on the average annual growth rate of 7.9%. This showcases the steady and reliable growth potential of SCHD, providing a sense of security for long-term investors. In contrast, VGT has experienced remarkable stock price performance, significantly outpacing SCHD. With an average annual share price increase of approximately 16.4%, VGT has benefited from the rapid advancements and innovations in the technology sector. This ETF has captured the impressive growth of tech giants like Apple, Microsoft, and NVIDIA, which have driven its substantial capital appreciation. For investors with a higher risk tolerance and a desire for aggressive growth, VGT presents an attractive opportunity to capitalize on the tech industry's dynamic and fast-paced evolution. If you had invested $10,000 in VGT 10 years ago, your investment would have grown to approximately $45,000 today, based on the average annual growth rate of 16.4%. This significant growth highlights the explosive potential of VGT for those willing to embrace the volatility of the tech sector. Dividend performance. Dividend performance is another crucial factor that distinguishes these two ETFs. SCHD excels in this area, offering an average dividend yield of about 3.5%. This yield reflects SCHD's focus on companies with a strong track record of paying consistent and robust dividends. For income-focused investors, SCHD provides a reliable and predictable income stream, making it a popular choice for those who prioritize regular payouts and income stability. For example, with a $10,000 investment in SCHD, you could expect to receive approximately $350 in annual dividends, based on the average dividend yield of 3.5%. This steady income can be particularly attractive for investors seeking to supplement their regular income or reinvest the dividends for compounding growth. On the other hand, VGT, while primarily focused on growth, also offers dividends, though they are generally lower compared to SCHD. VGT's average dividend yield is around 1.2%. While this yield is not the primary attraction for investors in VGT, it does provide some level of income. With a $10,000 investment in VGT, you could expect to receive approximately $120 in annual dividends based on the average dividend yield of 1.2%. Although this amount is relatively modest, it still contributes to the overall return and provides an additional layer of income alongside the significant capital appreciation potential. By comparing the performance of SCHD and VGT in terms of both stock price appreciation and dividend payouts, investors can better understand which ETF aligns with their investment goals. Whether seeking steady growth and reliable income with SCHD or aiming for high growth potential with VGT, this comparison highlights the strengths and trade-offs of each ETF. Investment strategy. Understanding the investment strategies behind SCHD and VGT is essential for determining which ETF aligns with your financial goals. Each ETF employs a distinct approach to achieve its objectives, catering to different investor preferences and risk tolerances. SCHD strategy. SCHD, or the Schwab U.S. Dividend Equity ETF, focuses on high dividend-paying companies. The ETF's primary strategy is to invest in a diversified portfolio of companies with strong dividend histories. These companies are typically well-established, financially stable, and have a track record of paying reliable and growing dividends. The selection process for SCHD includes rigorous screening criteria that emphasize quality and financial health, ensuring that only companies with sustainable dividend payments are included in the portfolio. SCHD's strategy aims to provide investors with a steady income stream through dividends, making it an attractive option for income-focused investors. The ETF's emphasis on dividend-paying companies also helps to mitigate volatility, as these companies are often less affected by market fluctuations compared to high-growth tech stocks. This approach ensures a balance between income generation and capital appreciation, providing a stable investment experience for those who prioritize consistent returns. VGT strategy. In contrast, VGT, or the Vanguard Information Technology ETF, targets the technology sector, focusing on companies that are leaders in innovation and growth. VGT's strategy is centered around capturing the rapid advancements and transformative potential of the tech industry. The ETF invests in a diversified portfolio of tech giants, such as Apple, Microsoft, and Nvidia, as well as emerging technology companies that are poised for significant growth. The primary objective of VGT is to achieve substantial capital appreciation by leveraging the dynamic and fast-paced nature of the technology sector. VGT's strategy involves identifying and investing in companies that are at the forefront of technological innovation, with the potential to revolutionize industries and drive future economic growth. This approach inherently comes with higher volatility, as the tech sector is more susceptible to market fluctuations and rapid changes in consumer preferences and technological advancements. For investors with a higher risk tolerance and a focus on long-term growth, VGT offers an exciting opportunity to capitalize on the potential of the technology sector. The ETF's strategy of investing in both established tech giants and emerging innovators provides a diversified exposure to the sector's growth prospects, balancing the risk and reward dynamics. Long-term potential. When it comes to long-term potential, both SCHD and VGT offer unique advantages that cater to different investor goals. Understanding the long-term prospects of these ETFs can help investors make informed decisions about which one aligns best with their financial aspirations. SCHD Long-Term Potential. SCHD with its focus on high dividend-paying companies, is designed to provide a reliable income stream while also offering potential for capital appreciation. The ETF's emphasis on financial stability and dividend sustainability means that investors can expect a consistent flow of dividends over the long term. This steady income can be particularly beneficial for retirees or those looking to supplement their regular income. One of the significant advantages of SCHD is its potential for dividend growth. Companies included in SCHD's portfolio are often those with a strong track record of increasing their dividend payouts over time. This growth can lead to a compounding effect, where reinvested dividends contribute to further capital appreciation. Over the long term, this can significantly boost the total return of the investment. For example, if you invest $10,000 in SCHD and consistently reinvest the dividends, the power of compounding can enhance your returns. Assuming an average annual growth rate of 7.9% and reinvested dividends yielding 3.5%, your investment could grow substantially over several decades, providing both capital appreciation and a growing income stream. This dual benefit makes SCHD a compelling choice for long-term, income-focused investors. With a $10,000 investment in SCHD, assuming reinvested dividends and an average annual growth rate of 7.9%, your investment could grow to approximately $43,000 over 20 years. The consistent dividends would provide a reliable income stream, enhancing the total return through the power of compounding. VGT long-term potential. VGT, on the other hand, offers a different kind of long-term potential centered around the explosive growth of the technology sector. The ETF invests in some of the most innovative and high-growth companies in the world, which are often at the forefront of technological advancements. This focus on innovation and rapid growth positions VGT to capture significant capital appreciation over the long term. The technology sector is known for its high volatility, but it also presents opportunities for substantial returns. Companies like Apple, Microsoft, and Nvidia, which are part of VGT's portfolio, have a history of transforming industries and driving economic growth. As these companies continue to innovate and expand their market presence, VGT investors stand to benefit from the resulting capital appreciation. For example, if you invest $10,000 in VGT and hold it for the long term, you could experience substantial growth. Assuming an average annual growth rate of 16.4%, your investment could grow significantly over time, reflecting the dynamic and fast-paced nature of the tech industry. While the journey might involve more ups and downs compared to SCHD, the potential for high returns makes VGT an attractive option for growth-oriented investors. With a $10,000 investment in VGT, assuming an average annual growth rate of 16.4%, your investment could grow to approximately $180,000 over 20 years. This substantial growth reflects the high potential of the technology sector, offering significant capital appreciation for long-term investors. In conclusion, both SCHD and VGT offer unique advantages tailored to different investment strategies and financial goals. If you found this video helpful, make sure to give it a thumbs up and subscribe to our channel for more insights on investing and retirement planning. Also, leave a comment below with any questions or topics you'd like us to cover in future videos.